money that backs them. And my team is squarely focused on that lever of the money that backs companies, whether it's investors, banks, private equity funds, et cetera. So we're talking a lot about the private sector, but recently we've noticed that, especially in light of the US election, we definitely need to be thinking globally about climate finance, and that's why I'm excited to dive in today on the role of money, not just with companies, but also with emerging markets.
Fantastic. Thank you, Leslie. And as I mentioned, Nick Audiello with the Investor Leadership Network, which is an alliance of 13 institutional investors across the globe, asset owners and asset managers, working on a host of challenges in the climate and development space, one of which is mobilizing private capital to the emerging markets by a variety of mechanisms, which I'm sure we'll spend quite a bit of time today talking about. I think I'll kind of start this conversation off with maybe doing a little bit of scene setting. We know, number one, that emissions are continuing to rise. Those emissions are continuing to rise in emerging markets. And so if we're going to solve this problem, one, we have to go to where the emissions are. Two, there is a lot of reason for optimism. The way technology has been developing over the last few years, the commitment that capital has made over the last few years, the capital is forming. Now it needs to be deployed properly. But there are some specific challenges to the emerging markets that we are trying to better? No? Yeah, just use the mic. Yep. There we go. That's better. Perfect. So there are some specific challenges in the overall climate challenge, specific to emerging markets, that our investors and like-minded investors across the world are working very diligently to solve. Now, if we start looking at pools of capital and where they are in the global financial system, there are some that are more able than others in theory to fill some of these gaps and overcome some of these challenges. Long-term investors, in theory, like our members, which are largely pension funds, sovereign wealth funds, should have the ability to take a long-term time horizon on some of these markets and make a commitment to the development of these markets and a clean energy infrastructure in those markets. There are, of course, a huge number of reasons why that's not happening at the scale it needs to happen. We know there is a roughly $4 trillion financing gap in the emerging markets between the SDGs and the Paris Agreement. And we know even just if you look at some ways to do this, like blended finance, that's only mobilizing at best $200 billion a year right now. So there is still, and we have been talking about this for years, a huge gap to fill. So Leslie, I think I'll take it to you as the advocate on this stage. How should we start finally closing the gap in a serious and rapid way?
Thanks, Nick. You did a really brilliant job framing the problem and the gap. We hear big numbers all the time, and I don't know about you, but you can get really disillusioned by those numbers. Quantity is just, we hope it gets to be $1 trillion with goals committed at COP. And I think what I want to do here is paint a bit of an arc about how we're going to get to that number and why it matters. So I'm going to start with the long-term view. Day in and day out, I work with banks that you've all heard of, JP Morgan, Bank of America, asset managers like Nuveen. And I can tell you one thing, that they are thinking about profit and losses. The metrics that they're thinking about are solely metrics that can be reported on a stock market or a stock exchange or to shareholders. And that is what that is. And trying to change that is difficult. So long term, we though want to get them involved in emerging market finance. We want them involved in climate action, but that ocean is big. So I'm going to bring us now to the short term. What do we do? So there's a good amount of capital that is not necessarily focused on profit and losses all the time. It's called climate finance or development finance. They have other objectives, right? They're trying to think about how do we increase resilience for farmers? How do we adapt to climate change? How do we also not lose our money? They're fiduciary responsibilities to governments and taxpayers, but that money can be a little bit more flexible. The problem is those capital providers are not as obsessive about the metrics that matter to them as these banks are. So what we've been thinking about is we talk about this quantity so much. What about of this climate finance that is available to do this job? How can we get that to be way more quality? Meaning, how do we get it to actually be concessional? How do we get it to actually be accessible? And how do we get it to actually be impactful? Because right now, that is super opaque. How much money goes out the door that sometimes doesn't even go out the door, gets committed, and then doesn't actually flow? And is it doing the job that it says it's going to do? I mean, every year if we just talk about a new number and don't look back and say, what did all that money that we've already committed do? We're never going to bridge that ocean. That private sector that I talked about at the top is never going to take this credibly and see it as an opportunity unless this money that's trying to do a certain job gets its quality in order. So I'll stop there for now, but I think we can pick up on some of these points because we need development finance to be doing more of the job that we need it to do in order to bridge that gap.
Fantastic.
Okay, thanks for all that context. I think starting from the very high level, it's I think everybody's view that public finance is not going to solve the climate crisis by itself. So that's why a lot of talk is about public-private partnerships and blended finance and things like that. So now MSCI is deeply in the capital market sector, and so I can tell you a little bit about what capital market participants think about climate change and how they're using climate change data to make capital allocation decisions. And maybe then, in the spirit of what you talked about, we can kind of get a little bit closer aligned in the different funding ideas to really create those blended finance vehicles. Now, we have just conducted a study through our Sustainability Institute, which is, by the way, publicly available. You can download the report on our website on what our clients, 350 of our clients, think about climate change. So it's kind of almost like an NDC survey, but just among capital allocators in the capital markets. And this is what they think. So first of all, they're actually divided on emissions. So half of them think that emissions will rise for a long time, which is a little bit more the trajectory that you talked about. But there's actually another half of investors that think that emissions will actually peak within the next 5 to 10 years. And then the other thing is that our clients in that survey, that they think that more traditional Western nations like France and Germany are going to really deliver on their climate commitments, where they think that emerging countries like China and India are very unlikely to meet their climate commitments. So I think that's a very important survey result for the emerging markets, that we need to build more confidence on the investor side on those climate commitments. And then the third element is that investors are extremely focused on physical risks today. So especially when it comes to the emerging markets that are extremely vulnerable to physical risks. And I think that kind of points us to make the emerging markets more investable. We really need to do more physical risk research and include much more of the adaptation work that is going on to show, that the emerging markets are getting more resilient with respect to climate change. So, yeah, let's leave it at that for now.
So I guess, Leslie, you said you wanted to make this punchy. Let's, take a step back for a second. We're having this conversation because we don't live in a perfect world. In a perfect world, the emerging markets would have all stable political environments. They would all have above BBB credit ratings. They would all have all of these things that would allow investors to just absolutely go in right now. There is not like this, as you said, there's not some moral or ideological opposition to making these investments. There is simply math. These investors, other financial institutions, have to deliver a return. That is the system as it is set up, and that is not going to change in any meaningful time period from which we have to address this problem. And so we have to
try and figure out how to operate within this system to find new ways to mobilize this capital. One of the ways the Investor Leadership Network has been doing this is through partnerships across the ecosystem, and we find this to be extremely important because when you take away the numbers, the challenges, the opportunities, all of it, most things in business, in life, in the public sector come down to trust. And at the end of the day, there is a huge gap of trust between public sector that has so many goals that have been set, so many things that they've promised to their citizens that will be delivered with a limited capability to actually deliver those things, and the private sector, which sometimes just sees the public sector coming in saying, well, since I can't solve my problems and you have all this money, you should solve these problems for me. That's not a place where we're going to actually get to any kind of solution. And so what we have been doing is bringing people together across the private sector, across the public sector, across the philanthropic sector, which can play a huge role here, especially in terms of some of the catalytic, totally non-return seeking capital that is required here. And so, for example, we've built a number of partnerships. In 2023, we hosted with the Rockefeller Foundation a forum at the Bellagio Center that brought together the United States Treasury, the United States Trade and Development Agency, multiple multilateral development banks, institutional investors, and these were all senior leaders who, for the first time, it very much seemed in that room, were having a conversation about the same thing. And it became very clear very quickly that, some of this, for those of us who work in this every day, we know all of the issues, all of the problems, some of this is very basic level setting at senior levels of organizations in both the public and private sectors about who can do what and what in certain institutions cannot do. So, you look at members like mine, you have a lot of pension funds. At the end of the day, they are managing the retirements of teachers and firefighters and nurses and civil servants, and those people absolutely do deserve their retirements, their hard-saved retirements, and they deserve to have their money invested in a way that is going to ensure their dignity in later life. Now, many of those, especially in Canada where a lot of our members are from, also believe that a sustainable world is the best way to ensure long-term value creation. And so, Leslie, from your point of view, how are you seeing that particular question of how do you, especially in the environment we're about to enter now, how do you make that argument for building a more sustainable economy is good for business at the end of the day?
Thanks, and congrats to the convening that you hosted. It's not easy to get those parties in the room together, and to have them speak a common lingua franca by the end of it is really impressive work. So thanks for the work that you're doing there. So you raised some great points about the capabilities and capacity of what entities are able to do, what is truly within the domain of possible and what's not. So when we think about this, I think your bifurcation of public and private is really helpful. So on the public side, there's one aha moment that I think helps us, which is global markets are not domestic. Finance is transborder. 2/3 of all the money in the world goes through London every day, and that's just one city. So we see this money moving overseas and internationally, and akin to that, climate change is also global. So great, we have two systems that are both thinking globally. It does no one any service if an emerging market is over leveraged 5x and they're continually given more debt and more debt to the point where they can't service their loan and then they have to declare bankruptcy on any of these loans. That does nobody any good. So at this point, when you're thinking about development finance and emerging economies especially, does it make any sense to offer a country above market rate or even market rate debt to solve a climate problem? If you are a development finance institution, it doesn't, because then it all just falls apart. So when we recognize these realities on the ground, you start thinking, okay, what is within our capacity? And when I think of innovations like debt for nature swaps or just concessional finance in general, going longer term, lower yield, that's a win. And these are smart people at development finance institutions who can look at this macro data and say, how is our money going to play with other money? And if we can't do it because we're constrained, can philanthropy play a role? Can we see a first loss layer? I'm going to cite an example from my days at my former employer, Acumen Fund, where COVID happened and it was the relief fund, and companies that are working so hard day in, day out to provide energy access to customers. Leading companies like BioLite and D-Light and Easy Solar, all operating in some of the toughest markets in the world, they were going to face a cliff. They're providing critical services. You could argue in some ways are government services, energy provisions, to low-income customers. And in the face of COVID, this emergency, sales are really tough. How do you do B2C sales when COVID's going on? You can't. So all decades of hard development work faced this day of reckoning where it said, what are we going to do with all these social enterprises that have tried to walk this line between public and private service? And so stepping back and having the ability to think creatively, a team of I at Acumen Fund and the formerly CDC in England, now BII, came together and said, we need a concessional debt fund. It's not charity money, but it also can't be market rate debt to keep these companies alive. How do we offer loans to these companies longer term at 2% interest so that these companies can take on a loan, weather the gap of COVID, and keep operating later on? And Nick, I can't begin to tell you how amazed I was at the response of DFIs, of philanthropies who work together in this time of emergency to make it work. $120 million raised in 4 months. And we're talking from the Green Climate Fund, one of the hardest entities to extract money from. They were the first in this fund, offering junior capital, saying this is an emergency, we need to act, we cannot lose decades of progress on energy access. I have news for everyone. Climate change is an emergency. We are losing urgency. It is turning truly into climate chaos, not to stir the pot there. But we need to adopt the same, I've heard this meme, the same PR firm that COVID had for climate change, because it is that much of an emergency. So if one tiny company, Acumen Fund and BII, can raise $120 million in 4 months, if we can think globally about large-scale funds that can really move money, especially to the emerging markets that we're talking about here today, that's how you make money work, and that's how you solve more problems, by thinking that way.
Well, maybe I want to talk about a financing mechanism that was also debated pre this COP, which is the carbon markets. It's an obvious mechanism that is really important because it's one of the mechanisms that is extremely direct. So we've heard that, despite all of the negative messaging around this COP, that there seems to be an agreement around Article 6.4, which is an extremely important aspect of this COP this year. And it's really great to hear that there was an agreement overnight, and that is a first result that this COP is delivering. And I mean, we all know that the voluntary carbon markets really have a credibility problem. A huge credibility problem, actually. So some of the work that we're doing in our carbon markets data team is trying to really help overcome this problem, and it's all related to carbon markets integrity. And as most of you climate professionals are probably aware, the problem of assessing integrity of carbon markets project has many dimensions. It starts with the actual calculation around the mitigation, that has happened. Nature-based solutions, you have this problem of permanence. You have a whole host of problems related to the assurance of the implementer and the implementation. And then you have project-specific problems. And we have just created a carbon markets integrity rating for 6,000 carbon markets projects worldwide. And I want to highlight a little bit maybe the result. So this is a scale that uses the same scale as credit ratings. So first of all, there's not a project out there in the world that gets a AAA rating. I guess, we need higher ambition in the implementation of carbon markets projects to get there. We only have 20% in the AA range, but that's pretty good, I would say. My point is there are, really, really good high quality projects. And for the ones that aren't, in the AA regions, the ones that go into the A and B region, I think we've kind of identified where um, the points where these projects would have to be improved, so that they can get to a higher rating, and then hopefully the logic would then be that these become much more investable, and that companies would be continuing to buy these projects, and I think that's a really good mechanism, because maybe, Leslie, we could get to those hundreds of millions in funding for projects for the emerging markets through that mechanism.
Can I add on the voluntary carbon market? Um, there's an important lesson in the voluntary carbon market that I want to extrapolate out to that quality piece, which is the voluntary carbon market has done a great job of embedding impact in the instrument, in the credit. You talked about these ratings. The fact that none are AAA, as you said, we need to increase ambition, but good on us for being honest about it. If you're going to buy a credit, which is what the private sector is going to do, they don't have to think about, is it impactful? It's built into the credit. If the indigenous communities have been consulted, if it's a high, if it's a JRED plus forest, is it different lower quality credits? But you can see and pop the hood on the credit, and impact is stated right there. We don't get the same for development finance in projects sometimes. We're just kind of taking bets. And I'm not saying that every single project from a development finance or emerging markets funding needs to be high impact and produce results. It's sometimes you have to take risk and it doesn't work out. But we should try to at least embed impact at the front and also report on that. Because a carbon credit is going to perform ideally like a carbon credit is going to perform. The legwork has been done and baked into the credit. But when we see development finance, we don't always get that follow-up, right? Did that dollar work? And if it didn't work, for God's sakes, tell us why it didn't work so we can stop doing that all over again. But we don't know. We don't know half the time what the impact of this $100 million fund was, this $1 billion fund. We see so many splashy announcements. Even if I just walked around this COP right now, I'd probably get to hear and sit on 5 announcements of $100 million facilities that are doing this really exciting thing. I'm getting tone deaf to it because I want to hear about what actually happened from the $100 million from 10 years ago, and did it actually work or not? Someone said once we should have every other COP should just be, the reflection COP and the forward-looking COP. I'm kind of into that, and I'm really more interested in the ones looking back on what's been effective, because after a while, big numbers start to lose their effect.
Well, and especially big numbers with no change in trajectory, and that's where it gets. I want to come back to 2 points. One on the carbon markets, and there is, when we talk about mobilizing all this capital, there are many ways to do it. I see our friends from the ILX fund here using data as a way to mobilize private capital into emerging markets. There are many ways to do this that don't require concessional financing, but many ways do. And we talk a lot about blended finance. I think when I read the news this morning about this development, I think there is a huge amount of this money that can be directed to mobilizing private capital in a lot of these cases and can play a concessional role. And we saw at COP 2 years ago where the United States made this big announcement, John Kerry made this big announcement of, okay, we're going to use voluntary carbon markets to actually start trying to do this. Again, we got to get going. 2 projects. I think projects is a very, very important point. And you see this especially at the intersection of corporates and finance. And, we can talk all day long about how to get money moving and where the money is sitting and why it's going, where it's going, and why it's not going anywhere. It does need something to go into. And there is a dearth of projects in a lot of these markets. And, you walk around this floor and you will hear about all kinds of NDCs and the project. The reality is, for most of those plans, if there even are plans, they're not well developed. And they are not projects that certainly institutional capital can go into. So this is an issue that is solvable, and it's actually a pretty easily solvable problem for not very much money. So as an example, one of the things that came out of this convening that we did in 2023 was a partnership between our members and institutions that our members work with, and the U.S. Trade and Development Agency, who opened a $100 million project preparation and technical assistance facility. 100 million. You can get so much done on technical assistance with $100 million because this is really just a small piece of the puzzle, but if the piece isn't there, the rest of the puzzle doesn't come together. And there is no commercial capital that is going to put it up, no matter how small the amount is. And this is one of those things that if you can just start getting into these countries, and you have to do this in partnership. This has to come from the economic development agencies in these emerging markets. But there are ways to do this so that there is a pipeline of projects, so that when you hear about these huge funds, they actually can deploy the money they have raised. And you see this all the time too. Huge fund raised, and then it just sits in cash, or it goes into some index fund forever, and while we're waiting for projects to show up. So I think the project is a hugely important part of this.
Projects are, and I even had to do my own research when it came to like who's developing these projects and what does it look like and what kind of money do they need, because again a carbon credit and the voluntary carbon market is part of a larger net zero ambition, right? These are for companies who are trying to achieve net zero. And my goodness, if we look at the role of AI and the new dimension of energy consumption that we're going to see globally, it's going to be harder to reach net zero, and thus all eyes on the voluntary carbon market to say, if you do have those ambitions of becoming net zero, which many companies do. EDF's worked with many Fortune 500 companies who are seeking to achieve net zero. You're going to look at the voluntary carbon market because there will always be a gap that you can't fill. So to your point about what projects do they look at, it's true. Project developers are, in this really tricky space, because once a credit is credited, it's not hard to sell if it's a good quality credit. The question is, what kind of money do we need to get from, let's call it ideation, to being project ready? And again, the role of creative financing is so ripe and exciting. I get really inspired by a group called Elemental Impact, formerly known as Elemental Accelerator. And they created an entirely new financial instrument, which anybody can do, called a D-Safe, a development safe. And traditionally, this was for energy projects, but you could totally apply it to nature and carbon projects too. So what a D-Safe does is it recognizes that the development phase of any project, whether it's building a nature project or a hydrogen facility, it's risky, right? Permitting, and it takes time, and off-take agreements, and just construction and cost of goods. Like, there's so many things that can go wrong. So why would we use a very rigid form of capital for this really risky time? And a development safe came out and said, right, what we're going to do is we're going to offer the developer, let's say $1 million, keep it clean and easy. But rather than prescribe the outcome and say, but it's debt and you owe us back 12% in 2 years, they don't do that. They keep it open-ended, and they say, in X number of years, let's say 3 years, 3 outcomes can happen. Maybe it does turn to debt. The project went fine. You pay us back the money. All good. Maybe, though, it makes more sense to make this equity, right? We want it to convert to equity like a convertible note, and then we're invested in your project. Maybe it's taking a little longer, but lots of promise, and we actually want to have ownership in your company. And the third is actually revenue share. And it also says, maybe this isn't a high-growing company and you can't pay us back the debt, but you can over 10 years. And we're going to convert this to revenue share. So over 10 years, once the project gets up and running, you pay us back over time. Brilliant to have that kind of flexibility and not just be so rigid with your capital and development finance. Same with a nature project, right? Why don't we give developers who are doing this hard work of incorporating native species and consulting indigenous people, which is hard work. I mean, none of us, hopefully maybe some of us in the room are doing it. I'm not doing it. It's hard work. Why don't we give them the flexibility of that capital to achieve what they're trying to achieve and still make our money back? I mean, it's still using finance for finance sake, but you're being more creative with how you're using money. And I want us to all be thinking that way. Elemental Impact is one organization. Imagine if we all thought about using our creative capital or capital more creatively to actually solve the problems that we're looking at.
Well, maybe I have 3 slightly random, only loosely related thoughts about what you were saying: capacity building, supply building of projects. So number one, we definitely see a trend from renewable energy projects which have a baseline problem, right? You don't really know, and to more nature-based CDR carbon dioxide removal projects. And the advantage that I see in that trend is that my hope would be that the CDR projects today, some of the larger ones might have extremely big capacity. Um, especially the ones related to mangroves or algaes. They don't require kind of a social societal change, like for example the cook stove projects, where you need to kind of serve whatever hundreds of thousands of families, but they can be implemented at a larger scale. So that's one thing. The other thing is, I think we are seeing, especially here at COP now, more and more bilateral agreements between countries on the corresponding adjustments, and the corresponding adjustment mechanism is really great in kind of ensuring, or let me back up. So the big issue is with carbon markets, I guess, that you don't really want to use carbon markets as an alternative to decarbonization. It's meant for last mile decarbonization, not first mile decarbonization. But at the same time, we can't wait until we're at the last mile decarbonization point, because we got to start building the whole ecosystem and the technology now. So, and I think the corresponding adjustment system is exactly solving that problem. Maybe we could even have like a corresponding adjustment system for companies as well. We might want to talk to the SBTI or whatever, on whether that wouldn't be, a way to do it. So what I'm trying to say is, especially here, as more nations are forming these international partnerships, I would hope, we're kind of really driving the supply. And then the third thing is we do see obviously, an extreme advance in data availability. With data, it's kind of funny. There's more data than we can ever consume, but specifically when you're looking for something, you never have the data that you would want. So there are two sources now: satellite data and AI-generated data, which are kind of new sources of data. I mean, satellite data has been around for a while, but we have all these public and private and in these partnership models that are providing data, and we have AI to process it. And I would think that especially on the nature-based solutions, I mean, if you look, for example, at a standard like RED Plus, it's they have like a 5-year period monitoring process involved in it. I think we can shorten that, and we can just see much more what's going on in the ground. We can ensure the quality a lot more through these new data sources. But we also have to realize that, especially in the emerging markets, we do face a data gap challenge than normally, even with like companies operating in the emerging markets. We're missing key information. There's oftentimes a that can't be supported by AI today, but oftentimes is still a barrier, and we just have much lower disclosure requirements. But we have a lot of standards emerging in Europe, that should be helpful when implemented in the emerging markets.
So I think, why don't we do we have questions? Yeah. We can do that. So I think, why don't we kind of go through and do some closing thoughts, and then if you're up for it, take some questions from.
Sure, and just thanks everyone for being here today, and Nick and Oliver for the great conversation. Closing thoughts. Everything that someone says can snowball into something else, which is exciting. I'll just give Environmental Defense Fund for launching a satellite, world's first ever methane satellite, MSAT, tracking in real time methane emissions around the world. One of the lowest hanging fruits for tackling climate change, reducing methane emissions. Methane really doesn't need to exist. It's kind of like the hole in the ozone layer. If we can pinpoint and cite where methane emissions are coming from and actually abate them, it gets really exciting. So just all eyes on data. I think it's been really important. Closing thoughts. it's hard work. I know that, and we hear that time and time again. When I think about the opportunity ahead of us, I think about emerging markets facing language barriers, facing high debt burdens. We just have to acknowledge biases that exist within us too, as when you're on the funding side as well. And thinking about perceived risk versus real risk. For example, Acumen's Hardest to Reach Fund was launched last year, and it looks at making sure that emerging fragile markets, really the countries that nobody wants to invest in, the Burkina Faso and the countries like Mali, where it just seems like all red flags from an investor perspective. Thinking about moving into these markets, I mean, where there is no market, there's full market opportunity, right? Because you can build something from scratch. So thinking outside the box really helps. I'm looking at this quote on the wall to our great hosts at the Climate Peace and Transboundary Resilience Pavilion. It says, between 2014 and 2021, fragile states received an average of $11 per person compared to $162 per person in more stable countries. These are the kind of things that are really important to remember. How are we ever going to get to where we need to go as a globe if we see these sorts of numbers and this sort of support? So just taking the opportunity and the power that each of us have to think about where we can apply our time and energy and remove some of our biases to start making sure money can flow, I think is just a closing remark I'd like to make before we open it up.
Well, my closing thought would be that I think we do all see, Leslie, I totally echo what you're saying. We do see a lot of investing opportunities in the emerging markets. I think what it really needs is a lot of grunt work, on those investing opportunities. And, it's not an easy journey. It's going to be a multi-decadal journey. But I think we shouldn't think about the extreme obstacle for some of these investment vehicles in front of us, but we should think about the steps that we can take towards making the emerging markets more investable and take those steps.
I think my big closing thought will be a absolute compliment to yours, and on the other side of that equation, just as important, leadership matters. I think if these are things. A lot of big financial institutions, investors like ours, the answer you get most frequently is to when we have conversation is, well, in the best case scenario, I can just go make the same amount of money by investing in something in the United States or Canada without doing any of this extra work you want me to do. And you're right. It is a lot of extra work to be able to justify these investments in a lot of cases, to do the homework that it takes, to do the capacity building within some institutions that it takes. And we published at New York Climate Week a compendium of blended finance case studies that looked at 13 blended finance funds, vehicles ranging from 25 million to 5 billion. And kind of tried to pull out what are the lessons here. And there were, of course, all of the concessionality and project preparation and all of this. But the ultimate conclusion was that within the private sector, at least, leadership really matters. To get these institutions that do have the quantum of capital to make a real difference, to deploy it, you need people within institutions to make it a priority, to give space for people to do the grunt work, to build the case to make these investments. And that, I think, at this time where we are right now in the world is even more important because I think no one is coming to save us. We have to save ourselves. So thank you to my panelists, and we'd love to open it up to a few questions from the audience. Sophie.
Hi, everybody. My name is Victoria Walker. I work for ILX Management. Can you hear me? Yeah? So ILX is... So this isn't necessarily a question. It's just more of an explanation of the ILX strategy because I think it complements very much what was being discussed by our fellow panelists. So ILX Management has just closed a 1.7 billion fund on behalf of Dutch pension funds, APG, and on behalf of Danish pension funds, Académica en San Pensión. We achieved this first close on Monday, so it's quite fresh news, some of the various announcements that maybe you'll be hearing. But it's quite a unique strategy because we're co-investing alongside DBs, multilateral development banks like the IFC, EBRD, to directly contribute to the SDGs and the climate objectives. But what is key here is that is not with concessional finance. So pension funds in Holland and in Denmark have decided to take on the full risk associated with the projects in development finance, in the development finance asset class. And it's important to note that the data is available to showcase that there is an increased perception of risk in these markets and that the actual risk is now lower, especially when you're investing in middle-income countries. There is a pipeline of projects that are investable. And the recently released GEMS database is also proof of concept of this. So while there are certain projects that maybe there is concessional finance required, specifically in fragile countries, for a big portion of emerging markets and middle incomes, we can look at we can think that the actual risk is lower. And working with MDBs ensures that we can access this pipeline of development projects, which are de-risked because of their experience in emerging markets. They are the original impact investors. They have been collecting impact data for 50 years and need this to prove to their shareholders, aka the governments across the world, that what they're doing is contributing positively to development. And we have gained access to this data, so we can on-report this to our investors who are also looking for impact and contributions to SDGs and climate finance objectives. The next step for us is really to ensure that this is scalable. We want to ensure that where it's possible to achieve this without concessional finance, that this happens, because we can't be looking to the shareholders of governments, of the MDBs, to continuously provide blended finance. This is not scalable in the long run. We need to take the risk. The world isn't going to change in terms of its risk levels. It's actually just going to increase. So we need to find where it's possible to take that risk. Thank you.
Thank you, and you guys have been doing such a fantastic job using that data. And it's a really important point that blended finance or in concessional capital, it's not some goal in and of itself. It's a bridge to somewhere, and it's one piece of a bigger puzzle. And you guys have a piece. We have another, we announced earlier this year with Secretary Yellen an emerging markets transition debt fund where a large group of investors, I think it started they're close to $1 billion now, of investing in corporate transition debt in emerging markets and going in and, where are these high emitting companies and how can you get investors to just buy corporate debt that is designed to decarbonize these companies. There's ways to do this that is not just concessional. And the important part here is that you need to have a way for multiple nodes in the system to play their role to the maximum effect. So where concessional capital can mobilize money where to a greater scale, it should, but then the private sector needs to keep coming in so that public money, which is much, much, much scarcer, can go to the highest impact places, to these more fragile places where the private sector probably is never going to go at scale.
I'll just quickly say, way to go. That's huge. It's so important because I said at the top of this panel, banks and asset managers, they care about profit and loss. And if you can start indexing, if we can all start indexing the actual returns that we can see from climate projects, they will run to anywhere they can make money. Run to it. But we need to index it and understand it and communicate it. And I get that they're not going to be the tip of the spear and take the first in risk. That's fine. But if others are, I mean, the more we can sing and be honest about the returns. If there's not an opportunity there, like, let's not, lead folks astray. They have fiduciary responsibility too. But where there is opportunity, all in, right? All in. As we evolve, I mean, we're going to need to see more investable opportunities. And if they lie in emerging markets, then, it's going to be a race. It's going to be a race to them once we can start showing those returns. So just super well done.
Manfred, I think, and then we'll go over here.
Yeah, I just want to respond to some of the narrative you mentioned. I'm the founder of ILX. For a long time, I worked in development finance. the fiduciary responsibility of the foundation of our financial systems, which is the long-term savings of our societies, is not a profit maximizer. I want to just say that. And please do not use words like that, because that is not what the pension systems are after. They are looking after the pensions of our citizens. The sovereign wealth funds are like to look to provide to their people in the post-carbon age, which hopefully is for the coming centuries. And so if we are going to be looking at this transition purely for the rent seekers that want to maximize profit, we're doomed. So I would recommend that we change our narrative and we focus on the harbors of our savings, who we have to build upon. Thank you.
Hi, Brandon O'Hanlon from RMI. I thought maybe I'd give either Columbia or Leslie some work to do. I think the ILX is an amazing example of just the multi-years that particularly the Scandinavian pensions have done in the space here. But there's kind of a problem because you do not see pensions, in the client finance world. The best thing that you ever hear, like one of the top ideas as far as grants for development, project preparation facilities is let's get the pensions more involved. Right now, I think there's a hidden lesson to be learned here that you have a small corner of the world with very advanced pensions who are looking at exactly their fiduciary duties like all the rest of the world is. So what is it about the legal regulatory context that enables those funds to move? And I think for those who are in the think tank world and the academic world and the policy mobilization mode, let's try to figure out how we can get pensions more to act like that. Please. I'm now taking over this panel, apparently.
No, it's a very good point, because obviously there is a research, and we can provide that there is no difference between the pension regulator in Canada, Japan, Korea, the Netherlands, Denmark, Norway, Sweden, Finland, UK. It's exactly the same. Yeah, it's that you cannot make investments for other than your fiduciary responsibility, which is to provide for the pensions for your citizens. Which, of course, pensions are cash. Pensions are not paid in carbon credits. So they're exactly the same. But you also have fiduciary responsibility to look after your stakeholders, and that narrative is a bit different. Definitely in the United States, but not different in Canada. It's not different in Japan and Korea and the other European. So I think it's what I've learned is that this is a narrative that's being espoused by the layer that's on top of these pension systems, because they are the ones. They're the ones who do not want to go down that path, because it's a more complex path than working the traditional forms of finance. Traditional forms of finance, the way you use your words, which we're in this transition altogether, is they like that because that's easy. That's what they've done for the past. So this new narrative is difficult for Wall Street and the City of London, and they're struggling with it. Our fund we're directly contracting between pension funds and the IFC. There is zero leakage. Zero leakage. There is no cost involved between the contract between a pension fund and the development finance system. It's very inconvenient for Wall Street. It's very inconvenient for the City of London, because they live on the intermediation function that they have on top of these pension systems.
So I think that's actually a really, really important point. And, change is hard, of course. But, you look, my members are the Canadian pension funds. 20 years ago, had you ever said you were going to be, all of these pension funds would be basically private equity firms making all their own direct investments, people would have looked at you like you had 10 heads. So at the very least, it is possible to try new things, to open new things when the opportunities exist. And I think what you're doing in making it clear that these opportunities do exist and that they are investable, and the work that so many other people are doing is hugely important. Do we have any other questions?
Hi, thanks for the panel. So you talked about how to find bankable projects in emerging markets by decreasing the risk perception, by using concessional finance. But I was also wondering if you had investigated on finding adaptation projects, because it's easy to potentially find a return on investments if you're doing energy efficiency or renewable projects, whereas for adaptation, which would be pretty much a big thing in emerging markets. There is few projects where you can actually find a financial system to invest in those instead of other than just public money. Is this something that you have been studying?
That's an excellent question. And Leslie, if you want to take it first, go ahead.
Sure. Adaptation is super tough. Training farmers is not the biggest moneymaker. We know that. An area that our team has been exploring and other great NGOs like Rocky Mountain Institute and Ceres is looking at, there's one financial product that's job it is to assess climate risk. And whether we like it or not, it's insurance. And insurance's entire business model is looking at risk dimensions. So we can have as many naysayers on climate change, but one entity is not going to not look at the data, and that's the insurance markets. Now, you might think, oh, insurance, like that, that could be even like predatory sometimes when we think about farmers. However, there's some interesting examples I've seen where you can actually build in resilience into your insurance model. So, for example, if you are a farmer and you've been stricken with drought or floods or whatever it might be, but you have an insurance package and policy, you could look at when you get your payout to actually build in resiliency mechanisms. In that moment, it's advantageous for the insurer, for that farmer to be regenerative, right? Because it reduces their risk. So how can we look at empowering, training, improving the regenerative nature of agriculture or soil improvements, thinking about nitrogen levels in soil. Some are too high and some are too low, but using data to give farmers what they need to produce better yield and ultimately build more resilience, because at the end of the day, that works for an insurance company. That's a winning policy for them. So that's just one model. I will say they're really tough. I've seen some interesting, on the Green Climate Fund's site, you can look at their adaptation projects that they've funded. Many MDBs are facing the plight of way too over-indexed on mitigation and renewable projects and way under-indexed on adaptation. So something to start looking into is looking at all of these adaptation funds. And also, as I said at the start, are they generating returns? Because if they're not, again, maybe we should be looking at more philanthropic and concessional sources rather than just saying this is, Main Street's problem to solve, which might be tricky in terms of what we're trying to achieve. But anyway, that's just one model I've seen. I don't know, Oliver, if you've seen some adaptation projects.
Yeah, we've just published a report with the, that's why I'm scrolling here on my phone. We've just published a report through the MSCI Sustainability Institute called Unavoidable Opportunity, How to Make Climate Adaptation and Resilience Investable. And what we've actually done was we've worked with GARP, and we've applied their framework for investing in climate adaptation and resilience using our ESG ratings team and analyzing 800 companies. And we found that around 11% of the business of those 800 publicly traded companies has a relation to adaptation and resilience. And so, I highly recommend using this GARP framework to analyze projects and kind of maybe look at that report and see how, we've made that identification.
Yeah, that is an excellent question. I think you hit on something that's extremely important. Like when you have the MDBs so over-indexed on mitigation projects, and let's be perfectly honest, in many cases, projects they do not need to be involved in to make happen. They are eating up capital that could be going to adaptation. The insurance markets there have only really been, if you kind of do this very wonky, geeky history of the global economy, like insurance is normally very boring, except for certain times of crisis and transition, and this is one of them where insurance actually has a huge role to play here. It's not only emerging markets where adaptation is hard. It's hard in developed countries too. You see that every time the hurricanes are indiscriminate, they hit emerging markets, they hit the United States, and people have not prepared. In fact, people keep moving to Florida and building new houses on the beach. Which, the simplistic way to look at it, but it's a huge problem. But there are just going to be a lot of adaptation projects that are not return generating and probably shouldn't be. I mean, these are in many cases going to be public goods that shouldn't be return generating, which is even more to underscore the point. where private capital can come in and find a return to tackle other parts of this problem will free up more capital in other parts of the system to tackle adaptation.
Nick just reminded me of something when it came to it not being sometimes a market-driven opportunity. There's a word that comes to mind when I think about any adaptation measure, and it's bundling. And it's so important to bundle services together in business models that make sense. For example, the cold chain, right? Trying to keep food cold from farm gate to being sold at the store. Along the way, you can think about very market-driven opportunities like a refrigerator, right? Just keep it cold. You can rent space in the refrigerator. Farmers make more money because their products stay cold. That actually is an adaptation measure, even though it's actually kind of guised as a mitigation measure because it's mitigating the fact that they would lose their crops. I think back to my own car insurance plan, right? My car insurance company in the United States offers me for free AAA if my car breaks down. That has no value to them. However, it's adapting me to a situation if my car breaks down. They've bundled this service in to something I'm paying for that's much wider. How do we think about not adaptation of just like single narrowly thinking about farmer training, but bundling it as part of a wider solution to a farmer? When we're selling seeds, sell seeds. There's money to be made in selling seeds, right? How do we think about making this a more holistic package that includes adaptation, not just as one sliver that we're trying to back that business model, which may not have one, into something wider?
Excellent. Yep. No? Any other questions? All right. Well, thank you all for coming to listen to us muse up here in front of you. Welcome to Baku. I hope you all have a fabulous week, 2 weeks, however long you are here. I'll say thank you for being here. This is a quieter COP than normal, but it matters. This work really matters, and I know that everyone in this audience is doing something that makes a difference. So thank you, and thank you to my panelists. We handled it.
Yeah.
Ah, fantastic. Great to meet you.